Maybe you're an employee and have been offered shares in the company, or maybe you're a business owner and you're looking to incentivize and retain key talent. Sweat equity can be a great solution for both parties involved. I'm Malcolm Zoppi, an English qualified corporate solicitor, and in this video, we'll discuss sweat equity. We'll go over three main things. First is, of course, what is sweat equity? Secondly, how does sweat equity actually work in practice? And thirdly, how would you structure your sweat equity agreements? What kind of things do you need to include in your contract? Fantastic, let's get started. So, chapter 1 is, what is sweat equity? In short, it is buying shares through hard work and efforts as opposed to money. The person contributes time, skills, and effort. In return, they get company shares, ownership in the company. These kind of shares can be great for business where, for example, one partner brings money and the other brings the sweat, the expertise. A lot of tech companies love using sweat equity. For example, a developer would code for equity, a marketer grows the business for shares. Everyone wins when the company does well. Fantastic. Let's move on to chapter 2, which is how does sweat equity actually work in practice? So the first thing that you would want to do if you're the business owner is try to put a value to the skills and effort or the outcome that you're looking to receive from that key employee. So if you were going to go out in the open market and, for example, approach consultants, how much would you need to pay a consultant to get you that outcome? So effectively, that's the value. And then you would compare the value to how many shares in your company equate to that value that you're seeking from your key employee. That's just one way to do it. That's maybe the way I would want to do it. There's no right or wrong way or no legally mandated way to go about this. Then you would detail that arrangement in a sweat equity agreement, something like a share option plan between the company and the relevant employee. One thing you'll want to do is speak with your company's accountant because there might be tax liabilities or exposure for the company when it comes to giving shares to employees if that's forming part of the remuneration that the company is giving in return for services by the employee. So you'll want to be very careful about that aspect and seek advice on how to make sure that we comply with the relevant regulations from that perspective. Now, before we discuss the kind of things you'll want to include in your sweat equity agreement, feel free to email me if looking for professional legal advice. With my legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. Fantastic. So let's move on to how to structure a sweat equity agreement. First, you'll want to specify the kind of share that the employee is going to be offered to purchase in your company. It's very possible that your company has different classes of shares, one for the founders, one for the investors, and one for key employees. In that case, if you've got different classes of shares, you'll want to specify that the employee, of course, is going to be buying that specific class of shares. If instead your company doesn't have different classes of shares, you should strongly consider doing so, adopting bespoke articles of association and detailing the different classes of shares, the different rights and obligations and restrictions imposed on the shareholders of those specific classes of shares. If you'd like assistance with this, feel free to email me. Very happy to help. Secondly, you'll need to specify how much the key employee is going to pay to buy those shares, because typically the way it works is that you're giving the option to the employee to buy shares, specific amount of shares at a specific price. The reason why this is very beneficial for employees is because typically the purchase price per share is either a nominal amount, like £1 per share, as opposed to what investors would be paying, which is, let's say, £1,000 per share, or a greatly reduced price, for example, £500 instead of £1,000. Secondly, you will need to detail what needs to happen for the employee to exercise that option to buy shares. So, for example, it might be that the employee has to stay with the company for at least 3 years before they can exercise an option to buy shares. And then each following year, they've got another option to buy shares. Or it could be that they need to meet specific KPIs. So, for example, you might say that if you've got a sales guy and you want to incentivize that sales guy, you might say, if you get me £3 million in revenue in sales, then you can buy X amount of shares, or any other milestone. So, for example, you might want to say that if you go out there and you raise X amount of money from the lending market, then I give you this amount of shares. Effectively, shares in your company become like money. You're effectively printing money as printing share certificates and using this as consideration in exchange for value from key employees. Of course, the more you print, the more it dilutes, just like with money. The more there is in the economy, the more things cost, the more shares you would need, for example, to achieve X amount of value. And lastly, the contract is going to need to specify the system system that needs to be followed more in a logistical way for the employee to exercise their option to buy shares. So it might be as simple as the employees to give notice at the relevant time that they're exercising their option, and the company must comply with that notice and give the shares to the employee. So that's how sweat equity helps incentivize and retain key employees whilst giving the company the ability to receive value and paying for that value, not with actual cash. If you've got any questions, feel free to put them in the comments below. I'll be very happy to answer any questions that you may have. Now, if you found this video useful, make sure to watch my next video right here about joint ventures and joint venture agreements, which is very similar in principle, but with different stakeholders and adopting a different structure. Thank you for watching.